Oil and energy stocks continue to skyrocket. But wait a second. The so-called safe assets like gold and Bitcoin and U.S. Treasuries have gone down since the Iran war started. What is going on? We're going to answer some questions and take a look at that through the lens of ETFs. Welcome to the program, everybody. I'm Ron DeLegge with ETF Guide. Let's start with a poll that was posted on the community center of our channel here at ETF Guide TV. We asked, when will the Iran war officially end? We've been hearing all kinds of crazy things. It was supposed to end in a couple days, then it became a week, then it became a few weeks, and now it's a few months, and now it's imminent to end, and then they're still sending Marines and troops over, but it's going to end tomorrow. So this is what you had to say. 42% of you, that's the majority according to this poll, said it was going to end in 3 months or less. The rest of you, it was spread out from a year to a week. And I am of the opinion that this is going to last minimum at least 6 months. And of course, we will see how this plays out. But just to deploy all of that equipment and those troops and those ships and everything, I mean, just to get them strategically in place and out of place, I mean, that right there takes a couple weeks to a month or so alone. So this is not going to be quick. This is not going to be easy. War is never that way. And it's always easy to start a war. It's hard to end them. Let's take a look at the actual bottom line performance of financial markets. These are ETFs tracking the major asset classes. We begin with spiders, which tracks the S&P 500 SPY, down now almost 5% since the start of the year. We're going to take a look at some of those industry sectors in a second that really tell us where the action is in terms of stock market performance. Bonds, we're going to take a closer look at bonds. The total U.S. bond market's down about just over 0.5%. And then global real estate down modestly. And then look at the runaway winner here. Commodities gaining over 23%. SDCI, we've talked about that ETF so many times. A great core commodity holding, 5-star rated, diversified exposure to commodities. You're not only getting some precious metals in there, you're also getting exposure to those energy assets, the ones that are popping right now, like oil and gas. So check out SDCI if your portfolio misses any exposure to commodities or is maybe underrepresented to that particular major asset class. This is your message to do something about it and take a look at commodities. SDCI is one of the best in the business. IBIT, which tracks Bitcoin, down about 19%. And this is going to be kind of the theme, one of the themes on today's program is these so-called assets that are so-called safe assets not performing so safely. And so I want to give you some context as far as where these types of assets get deployed inside an investor's portfolio so that you're not disappointed and you're not damaged financially when things really begin to hit the fan. Right now, what we're seeing is basically probably what I would say a warm-up for much more volatile times ahead. And now is so crucial that you prepare your portfolio for these times. So in terms of S&P 500 industry sector, we have 11 sectors. If you slice up the S&P 500, this is what you have. Look at energy. XLE, the runaway winner. Not much of a surprise with skyrocketing energy prices of oil, of course, and gas and natural gas. That has boosted the energy sector, XLE, ahead by almost 33%. And then those other groups, we've got 6 up, 5 down, and really not much in the way of like sizzling performance from those other sectors. But energy is where the action's at for bulls. And so that's what you got to pay attention to. As far as these other industry groups, you know, the defensive sectors, utilities, and consumer staples, those ones are holding up. And those tend to be more conservative industry groups as a whole. Now, I wanted to isolate this chart. I built this to kind of illustrate how many trading opportunities that there have been in the gold mining and precious metals area. This takes a look at GBUG, which is an actively managed gold and silver miner ETF from Sprott, one of the best in the business. Then you've also got SLVR, which just focuses on silver and silver miners. And then you've got the leverage version, Nugget, NUGT, and JNUG, JNUG, of course, is junior or small cap miners, gold miners, and then Nugget is just the large cap miners. But look at the performance here. The last time we saw miners as a whole drop this much, they skyrocketed and bounced back between 20 to 43%. So just saying, I don't know right now. The chart, as you can see, the immediate chart is down, and they have taken a big dive really since the beginning of March. But at some point they will rebound, and the rebound will be fierce. So I'm just saying, from a trading perspective, what's the old saying? History rhymes. Doesn't always match up exactly, but it certainly does rhyme. So keep those ETF ticker symbols on your radar. Again, those of you looking for an entry point into the gold and silver miners, I think this represents a potentially good trading opportunity. Now, in terms of safe havens not behaving safely, okay, we already kind of charted that out earlier. Bitcoin down almost 20% since the start of the year. Granted, it has been up modestly since the Iran war started, but Bitcoin has not been a good performer. Gold has not been a good performer, down about 15% since the Iran war started. It's actually performed worse than U.S. stocks. U.S. Treasury, there's another so-called safe haven that's also been down. And so, again, what is going on here? Let's look at the charts. TMV, TLT, and BND, these are ETF tickers. Now, TMF is a bearish bond ETF that uses leverage, 3x daily leverage. This is from Direction, and it's focused on long-term U.S. Treasuries with maturities of 20 years or longer. You see, TMF has been the trade since the Iran war started. And then look at the other conventional bond ETFs like BND as well as TLT, which focuses on that same length of U.S. Treasuries with longer-term maturities. But these have been awful places to invest from a protection perspective, and that's because bonds, especially when you think about this in the context of what bonds represent, we're talking about loans made to the U.S. government or corporations. In the case of U.S. governments, when investors start selling bonds, it's usually because yields or our interest rates are going up. And everything is impacted by that. Mortgage rates, credit card rates, business loans, government borrowing costs also go up. And right now, the bond market is moving in a way that suggests higher inflation, higher interest rates, and more stress in the financial system. And the bond market right now is throwing off some warning signs. And it hasn't been discussed much because everyone's focused on energy. But pay attention to what's going on in the bond market. It affects every part of the economic ecosystem. And this chart, what's the old saying? A picture's worth 1,000 words. This one might be worth 10 trillion words. What about gold? Well, there too. Another safe asset, or what's been called a safe asset, has declined almost 15%. This is GLD versus SPY at the start of the war at the end of February, and it's actually performed worse. Gold has compared to stocks. And so I bring this to your attention not to dismiss the validity of these assets like bonds or treasuries or Bitcoin, but just so that you understand that in terms of your portfolio and how you're organizing the assets you own, there's three places that they go: your core portfolio, your non-core, or your safety bucket. And so when you begin to organize your investments in this manner, then you begin to really be able to not just grow your portfolio, but to protect yourself during times of crisis, during times when the market's crashing, during times when there's war and when there's blood in the streets like we have right now. And so your safety bucket is specifically designed to do something different than your core and non-core portfolio. Your safety cushion, by the way, is not market timing. It's different from your emergency fund, not the same. Those are two different things. And then it's a permanent cushion within your overall investment portfolio. So these three buckets or containers make up your overall portfolio. So what you're essentially doing is you're segregating your investments into these three containers. And so you're protecting yourself from the financial icebergs, right? The things like a market crash or accidents or higher taxes, illness, war, all these things that could undermine or destroy your wealth. And so what are the minimum safety standards of assets that go inside your safety container? Well, first of all, it must provide liquidity. That's a given, right? You got to be able to quickly convert it to cash. That rules out things like private equity, right? And things like real estate. It must also diffuse market volatility. And it must offer 100% principal protection. Those are the minimum safety standards for investments that go inside your safety bucket. And by that measure, things like gold, Bitcoin, and U.S. Treasury do not qualify because they don't have all three of these attributes. Must have all three. Not one of three, not two of three, all three. And so these other assets like Bitcoin, like gold, precious metals, silver, mining stocks, all that stuff, long leverage, long short, all that stuff, you can put that in your non-core portfolio, which complements the safety bucket quite well because it's not doing the same thing. That's the whole point. You don't want to have duplicated things going on, right? You want to have different things in each one of these containers, and that way you get a nice, complementary, happy result. Let's talk about U.S. debt, runaway U.S. debt, which is now at $39 trillion. We're going to be at $40 trillion by the end of this year. And you can see that the level of debt keeps getting worse and worse. And you know, the Pentagon just asked for $200 billion for the Iran war. They want $200 billion. And what? It's only been a couple of weeks? Let me tell you, folks, I think when the tab finally arrives, when the bill for this entire thing arrives, I think this is going to be a $1 trillion war, minimum. That's just me saying. I mean, if $200 billion here, $200 billion there, next thing you know, you're at $1 trillion. But again, as a nation, $39 trillion in national debt, we're above GDP. Well, the percentage of debt by the GDP is way above 100%. It's going to stay that way. So that's a problem. That's a problem because now, as interest rates start to rise, the debt load gets heavier and heavier. So how do we protect ourselves? Well, you combine protection and hedges. Now, these are two different things. Your non-core portfolio, the bucket, can own things like Bitcoin, gold, miners, and precious metals, which despite their lackluster results recently, especially since the Iran war started, I still think they have a place in the non-core portfolio and offer a good hedging opportunity, right? But they're going to have volatility. They're not going to protect your principal, right? And sometimes they also may not be as liquid as we want, especially during times of crisis. Your safety bucket, that's a whole different ballgame because it offers 100% protection. That includes buffered ETFs, which protect your principal and offer some upside potential. That also includes annuities, which again protect your principal. And then FDIC insured cash, which can include bank CDs. And you'll notice I got here a nice balance of three different solutions from three different industries: the securities industry, buffered ETFs, the insurance industry, annuities, and the banking industry, FDIC insured cash. So a balanced safety strategy uses a diversified approach, right? We wouldn't want to jam all our money into bank products or jam all our money into insurance products or jam all our money into security. you can diversify your safety bucket, as you should. So again, the three cornerstones of an architecturally sound investment portfolio: safety, core, non-core. These are the three cornerstones. And this is what I teach, too, in our online classes here at ETF Guide. More on that in a second. Let's talk about the big money as we wind up today's episode. Look at where the big money made its wealth and where that wealth is concentrated. I highlighted it for you to make it easy. 8 out of the top 10 billionaires on this planet made their money in the technology sector, and that's where their wealth continues to be concentrated. And that's a great lesson for all investors. Despite higher inflation, despite runaway government debt, despite runaway government spending, war, political chaos, daily irritations of life, all this, life is still becoming more and more digitized, and that's not going to change. And so the technology sector, from an investment perspective, your core and non-core portfolio should be emphasizing that. And that's just the way it is. That's the lesson. That's the key takeaway. Be sure to enroll in our free online courses. I've got links in the description section below. We got 3 courses: Safety, a Guide for Investors; Retire Securely, which is a great course for positioning your money between your taxable accounts, tax-free, tax-deferred, all that. And then, of course, other things that arise during retirement, things like taking care of yourself in the case of things that come up with your health, long-term care, as well as Social Security. So that is all covered in that free retirement course. And then Habits of the Investing Greats, learning from the investing greats, cream of the crop. That never gets old. So all these courses are free. Again, those links are provided below. Hit me up with your ETF battle request. We just dropped a new episode. OEF versus QQQ, S&P 100 versus the NASDAQ 100. So check out that latest episode, and then hit me up with your ETF ticker symbol matchup requests in the comment section below. We have new episodes of Metals in Motion, as well as First Look ETF coming up. And I hope you enjoyed today's episode. We talked about a lot today. A lot to think about in terms of how you orientate and build your investment portfolio with safety and growth in mind. Hit me up in the comment section below. I'm Ron DeLegge with ETF Guide. We'll see you on the next episode.